Hello, everybody. We're back. It's time for Truth or Skepticism. It's Wednesday. It's already the end of January. Dylan, it's January 31st. I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. How are you, Dylan?
Very good. I'm very good. You see that the Federal Reserve says we're looking, what do they say here? They say risks to goals are moving into better balance. That's
risks to goals are, that's not what they were looking for.
They don't like that. Risks to goals are moving into better balance.
No, they were hoping for, that's a little bit of kissing your sister.
Don't see cuts until more confident inflation nears 2%.
Yeah, that's not what they were looking for. That
Fed
is
to consider any adjustments.
That is an I like
balance. We got some better balance going here, sir.
Yeah, I like you and you're a nice person, but I don't want to move in with you. Kind of thing.
I'll meet you for tea.
Yes. You're not quite dinner worthy.
Not going to spend the weekend in Vermont.
No weekends in Vermont.
So anyway,
I got a lot of topics today, and I'm sure you have a bunch too. There's just so much stuff, but I have to start off with something today that I was just having this argument. Believe it or not, we're sitting around the big table here today. It's a little quiet, and we're arguing instead of normally, 90% of today's discussions are, about football and the world and the Super Bowl and, Travis Kelce and Taylor Swift and the whole deal. And, typical, we're just your typical, I guess, water cooler chat anywhere. But all of a sudden we start getting into a discussion and a heavy discussion on this whole Elon Musk compensation package that was overruled by a judge in Delaware. And what's really interesting about it is, here are the two sides. Side number one is, hey, you made a deal. The board made a deal with Elon. I think there's 6 or 8 board members. The board made a deal with Elon, and they said basically, if you do this, you get this. Like, in other words, if you turn this company into $600, $700 billion company, which at the time there was not a strong likelihood of that happening. In fact, it was a very low probability, maybe less than 5%, maybe less than 1%. You will get what will be the equivalent of $56 billion. Okay, we didn't know the exact number, but based on today's prices, it'd be the equivalent of $56 billion. And because everybody wins then. You win huge, the company wins, everything, this is the deal we're making. No strings attached, and when I say no strings attached, that means you can still do other stuff. We don't care how many hours you work, blah, 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 the whole deal. You do whatever you want to do. You get this company to be worth that amount of money, and you're going to be in Fat City. 56 billion with a B.
It's just a percentage of the pie. It just happens to be big.
Yeah, percentage of the pie happens to be
8-10% of the action. If you make it bigger, that's reasonable for a leader.
Okay. So, and then whatever it was, 6 years later, boom, I think this was 2018, 6 years later, here we are, here's the number, it's 56 billion. Elon says, pay me. And a Tesla shareholder says it's ridiculous. Not the board, not, a Tesla shareholder says it's ridiculous. I'm going to take this to court in the state of Delaware, and the judge agrees with the shareholder, and the contract is voided. Pretty wild. Okay.
Well, I mean, is it though? I mean, again, the way capitalism works is there's some set of shareholder rights that exist in a contract with anytime anybody raises money.
That was not the.
Let me finish.
Okay.
Let me finish. that there's a set of shareholders' rights that are both in governance and implicit in moral, implicit. And the board's responsibility is to shareholders first and management second, management working, the board being an employee of the shareholder. I'm sure what you're going to say was that they had no standing as shareholders to intervene with the board. So they had that was not the basis of the ruling. Rather, the basis was more of a discretionary ruling tied to an opinion of abuse, I'm assuming.
Yeah, the shareholders had zero say in this. The shareholders, the shareholders were not. The shareholders did not vote on this and agree to that. The shareholders have no idea what the board.
No standing.
Yeah,
no standing.
They had no idea what the board was doing or awarding, to Elon at the time. Right.
What was the basis of the ruling? Was purely moral?
Yeah, pretty much. Unfathomable was the term that they used. An unfathomable number.
Too big. The number is too big is the problem.
An unfathomable number. 56 billion is an unfathomable number. I think it's really interesting.
That's pretty bad news right there. I mean, you don't like to hear that, quite honestly, with all due respect.
You don't like to hear what?
That that the U.S. judicial system has a moral opinion on what is a fathomable number without any rules or guidelines of any kind.
That's
I was
right.
hoping that some standing for the shareholder here, because I am an advocate of shareholder rights, and I can see where a shareholder would have standing to call this compensation abusive of the shareholder in a pocket deal between the CEO and the board.
Sure.
But if this contract doesn't give you that standing to go with a moral position in a Delaware court that just says the number's too big, and to get a favorable ruling seems to be a pretty flimsy judicial standard, regardless of the number. I mean, if what you're saying is true, it would seem that will get overturned.
What I'm saying is what's been published. I assume I'm sure it's all true so far. Yeah.
In other words, meaning that the shareholders have no standing, and that the ruling is predicated on a perception of abuse because of the unfathomable.
There were other aspects to it. It's not. Yeah, there were other things suggesting that there were no boundaries. It was made. It was more of a.
I would say, but it brings up a couple of issues. One is the widespread abuse of shareholders for years through passive investing as the primary mechanism of putting the shareholder to sleep and becoming powerless to be abused by managements and boards across centuries.
Of course.
Carl Icahn. I mean, this is the sort of first Boston. I mean, so many careers have been made and lost in the politics of that relationship. Law firms, the poison pill, all that Wachtell Lipton, making all the governance rules so you could own 1% of the stock and all the voting and all these games. And so I do think that the Elon compensation brings up the issue of the shareholder as like labor, like abused shareholder is a valid thing. But it's hard to see how this ruling, based on at least this limited information in this discussion, makes sense against him if the only critique is too much money.
Well, there's more than that, but the issue with it, from my perspective, the issue with it is, think about how dangerous this is if this stands, in the sense that what's going to stop any founder in the future, any founder, any CEO from creating a set of documents at inception that essentially say, at some point, like what if I had put something in our documents that said at some point, if this company's ever worth $1 billion, okay, I get an extra $250 million.
You get the half of the last quarter. Basically.
I get half of whatever the valuation is. Like, where do you?
The biggest swing.
This is the argument from the judge, and this is an argument that I actually I believe in, and I feel strongly. I agree with him in a strong way. I mean, I understand the deal that they made, but the other side to this is it is incredibly dangerous because the shareholders have no say in any of this. And you get situations. I'll give you another situation, even in our industry. There's a Robinhood, the brokerage firm. When they were raising capital, they took all the voting rights, essentially. The two founders got all the voting rights. I think 75, let's say 75 or 80% of the voting rights. So the stock that they sold to the private equity firms or the capital they raised with the private equity firms have no voting rights. So it is very difficult, I mean,
they call that the oppressed minority in the Delaware court, sir.
well, and the challenge with this, the problem with this whole thing is everybody's looking at this and saying, hey, a deal's a deal, honor the deal. And the problem with this is that A, it sets a horrible precedent. B, it's made, you don't know the circumstances under which the deal was made. And if Elon at the time went to the board and said, listen, if you don't agree to this, I'm leaving, and then everybody on the board has this crazy liability, which may not have been covered, and they're all at risk of being sued and being wiped out. I mean, there's all these different aspects to it, which actually scared the living crap out of me. And I am glad that the judge ruled the way he ruled.
So do you think that the judge is a shareholder rights activist judge in Delaware? Is that
not at all? I think the judge is somebody that took a lot of thought, a lot of logic, and said, hey, you know what? If I hold them to this $56 billion number and dilute this, what is going to stop every single company that C Corp that registers in Delaware, and every founder when they start, from embedding a clause in here which essentially says I get 6%, I get 10%, I get 25%, I get 50% of this company, when it sells at some number. And so every unicorn deal goes, I mean, it's potentially disastrous with no restrictions, like hey, you have to work a certain number of hours, you can't build other businesses, you can't raise capital, do other things.
Or performance requirements.
Or time requirements, or commitment or anything. It's just
the requirement is the value of the enterprise.
To say that number is unfathomable is actually a very good way to put it, because it by agreeing to that would open up so many, I think, disastrous long-term consequences. But yet, I was having an argument with somebody who was very passionate about the other side that said, hey, a deal's a deal.
But no, it's not. I would say there's more to it than a deal's a deal. So for sure, a deal's a deal. But deals get amended all the time, so that doesn't have a huge amount of integrity. But you also have the real value of a visionary founder, which Musk for sure obviously is an archetype of, is in the outside returns. Right? His deal is not irrational, which is that, if this thing is worth X, the distribution looks like this. If it's worth Y, it looks like this.
No. The deal's not
it's worth B, then my value, then the full vision has been manifest. And if the full vision manifests, then I get half. Right? That's Elon's discussion with his counterparties.
Just think about this. Would you, knowing this, would you ever invest?
You're saying because the founder rakes the cream, even if it works.
So you take all the risk and you get just a fraction of the rewards. It's absolutely ridiculous. Nobody would ever raise. It would be almost impossible to raise capital. It would be almost impossible to do deals. If people knew this stuff existed and these were the terms they were signing up for, nobody would ever sign up. Nobody would ever raise any capital. I think Elon is way off on this one, way off. I don't think he was with.
So is this an argument about the language of governance of a Delaware C Corp at the end of the day?
I think it's just an argument. I think it's perspective. I think that I think the term unfathomable money is right. It gets to the point where, there's something broken. And yes.
But what is that? So what's the legal definition in Delaware court of unfathomable amounts?
I don't know what the legal definition is. I just know that there was
That's the problem. No one does. So that's why you can make that the rule.
No, I understand. But now this has opened up a can of worms, and this has opened up some very interesting discussions that if you're a very strong founder, most founders don't have the ability.
One in a million. as a founder.
It's probably not one in a million, but it's probably one in a lot. And if you are that person and you have the ability to hold that leverage over the board, you'd almost be unstoppable, because you're essentially raising money for a unicorn for asymmetric upside with virtually no risk, and dumping all the risk onto the shareholders. So not only are the shareholders investing, not knowing how bad the odds are stacked against them,
because they're forfeiting the outside return.
Of course.
Up front.
A percentage of it. They're paying this massive vig. Can't get it back. I mean, in 99% of the cases, you can't get it back. I mean, there's one Tesla and 10 million companies that fail the other way. So it's not, you don't get it back. And so anyway, that's my counterpoint to the people that say, hey, a deal's a deal. You should honor the deal that he made in 2018.
Yeah, I mean, I just don't know how you get through what the definition of unfathomable is.
I don't know either.
I want to agree with you, but you're now assuming the moral position of the Delaware judge, like an old man on a hill. It's like pornography. You'll know it when you see it. Like remember there was one of those Supreme Court some decades ago. And so this is sort of what's an unfathomable amount of money. I don't know, but I'll know it when I see it, kind of a thing, which is sort of where the judge seems to be sitting, and apparently you.
Well, I really wasn't going to.
What if it was 20 billion? Is the number just too big? Is this a negotiation, or is this a moral issue?
Yes, both. I think so, both. I do, and anyway, I don't want to get into that, whether it's what's the number that works. I think in general, an incentive can be, somehow you'd have to justify the incentive. So if the incentive is, let's say, 100 times what the next highest incentive is, okay, fine. But if it's 10 million times the next highest incentive, it's stupid. I don't know. There should be some number. It's some multiple of. It's just got to be a math equation eventually.
But so the definition of unfathomable is a multiple of the base salary of the company, for instance.
A multiple of what the
average for the
average bonus or average incentive bonus is, whatever that means. So if the average employee gets $1,000 and or let's do it the same way, the average person gets $560 and you get 56 billion, what is that? 10,000 times or something? I don't even know.
It's an abuse of the people.
Yes. If you want to go 50x, fine.
The shareholders are the workers of the capitalist world.
Yeah, the shareholders took the risk. The shareholders deserve the return.
The shareholders have been compartmentalized inside of passive index investing and proxy voting ever since the poison pill. I mean, the shareholder has been put to sleep.
Yeah. Well, if you want,
which is why this happens in the first place.
If you want this system to continue to work the way it does, and it works really well, you've got to protect the shareholders, and that's what this judge did. I'm all good with it. All right, I don't want to beat it to death. I just wanted. I find
don't have to beat it anymore, but I do think that shareholder activism is majorly impaired over the last 20 years by the narrative of passive / managed /
Yeah, like I don't think founders should be able. I don't think founders should have all the voting rights, because there's no system of checks and balances. I don't think founders or CEOs should be able to determine, use whatever leverage they have to determine some unfathomable number, should the company be successful. I think there needs to be, certain restrictions in place, certain rules. And I think that this is the right decision, regardless of what was agreed upon, because obviously whatever was agreed upon was either done under duress or nobody had any clue what they were doing. And that's probably the latter. Nobody had any clue what they were doing. Anyway,
I would say legally, I suppose I agree with you. Legally, I would think that they would have to rule in his favor because there is a contract and there's no apparent breach, not knowing, and then perhaps intervene and say never again. It's sort of like it's like maybe locking the door after the horse leaves and all that. But I just don't know how you get out of ultimately honoring a contract.
We'll see. I don't know either. I just thought it's a very interesting topic, and one that I don't think we should, we should have blown off. Okay, I'm going to move on because I know you got a bunch of stuff, and I want to talk about one other thing I've been talking about a couple times on air, and I just think it's really important. I have, never been a fan of any kind of fundamental analysis in any way, shape, or form. We had a debate on air, last week about fundamentals versus efficient market theory and things like that. But and I've always argued that analysts exist for this. Research analysts and institutional analysts exist for the sole purpose of providing litigation protection, against bad trades. It's that simple. And this past week, BlackRock came out and gave a double upgrade to the U.S. stock market based on what they thought was kind of a crazy kind of upside in U.S. chip stocks. And I found the double upgrade, not just an upgrade of U.S. stocks, a double upgrade, to be strangely timed, weirdly self-promoting, and very much out of touch with reality. Because if you are trying to, over time, if you are holding $10 trillion of long stock like BlackRock is in long baskets of institutional money, and you have the largest portfolio book in the world, and you say, "Oh, I love what I own," at all-time highs, kind of message are you sending to the world of finance, which essentially, if you sat down with Larry Fink one-on-one and Dylan Ratigan was interviewing Larry Fink, he would tell you, which you've done, okay? Multiple times.
Very approachable, really.
Okay, and you know what he would, I'm going to guess what he would tell you. He would say, you know what, if you want to be a successful investor, you got to buy low and sell high. He's old school that way.
I would even say more than that. I would say you got to be long America.
Well, that's fine. Long America is totally fine. But as
long as you're long America, you're going to win.
But what he would say is you got to be long America. But he would also say you got to buy them when they're down and you sell them when they're up. And yet, the company message to the public, because of their institutional positions, which I think is very self-promoting, is we're at record highs. Just close your eyes and buy them.
Or they feel like they have an insight of the order of magnitude of the growth in the chip market and the radiance of that is legitimately more abundant than we realize.
So, okay, assume that's right. Then why say it now? Like, what's with the timing? The day you make record highs.
January. Beginning of the year.
It's the
after the holiday. Everybody's back to work. Late January. Enough with the riff-raff. We're into the year here. What do we think?
It's January 28th. Okay.
Right before the Fed meeting.
It's January 28th. And you're making this statement on January 28th.
I've got all this data from the beginning of the first quarter. I got some visibility at NVIDIA in Taiwan.
No.
I got at least to the boardroom. I got to the banking side. I got a sense of the credit and who's pulling credit and who's reserving resources to do things. I got a little viz. I got a little bit.
Do you believe that the market normalizes everything by creating essentially by normalize everything by handicapping risk? And when you're at an all-time high, the chances of the marketplace going higher is just as good as it is going lower, maybe even a little bit better of it continuing to go higher, like they said. But the risk to the downside is that much greater because that's your handicap of the embedded upside which is probably
I
more
got it. I think
likely to happen.
your entry point, you have a narrower window of correctness in which to be profitable.
That's right. And not only a narrower window, but you also have a lot more downside risk than you have upside potential. And because of that, that's how the market handicaps, buying at all-time highs. Don't you think that it bother you that if they were truly objective, would they be saying this if they weren't long $10 trillion worth of stocks here?
Of course not. But I think that when you are, if you're Larry Fink or if you're Warren Buffett, maybe not now, but in the past, or if you are a Treasury Secretary or Bob Rubin at a moment in time in the past, and different sort of figures, either bank CEOs, asset managers, or government officials, who by their office must represent an optimistic point of view. And I would look at the Larry Fink Blackstone note as a big swing, but one with no risk, because if they're wrong, no one's going to pull the money, but they're more serving a political purpose. And because of their assets, it becomes self-fulfilling, because they're spreading the gospel of their own asset position. You're saying it's disingenuous to reality.
Yeah. It's disingenuous to reality.
Do you think that's self-evident?
Disingenuous to reality and risk.
Yeah. But I think that's self-evident. Your point is it's a marketing and litigation management asset. It's not an accuracy asset.
Of course not. Right. Exactly.
And so
I'm troubled. I'm troubled by it because I feel
accuracy?
I'm troubled by it because I feel like this is one of the integrity hurdles that we are constantly trying to face, and nobody calls these guys out on it except for me. Like, nobody else is calling them out.
You think these people shouldn't be taken so seriously? It shouldn't be Blackstone inspires the market to soar to new highs with authoritative opinion. It should be Blackstone hypes its own book at all-time highs with nothing to lose.
Exactly. That is the headline that should have been coming out, except the headline that did come out is that Blackstone doubles gives a double
upgrade to American stocks.
Exactly.
For the future time.
And the headline should have read, Blackstone talking its own book, upgrade stocks.
So that's an editorial critique that is intrinsic to the entire information.
Well, except that it wouldn't exist. That opportunity wouldn't exist if they didn't do that. So I don't understand why they would do that. That's all. Why they would even make that.
What? Blackstone or the report?
Blackstone.
You're saying it's a stupid risk. You're like, why stick your neck out at all-time highs with some hype upgrade?
Exactly.
Doesn't make.
Exactly.
So maybe that's why you do it. Because the headline value, anybody can call on lows. It takes a maniac to call a double bump higher at all-time highs. It's better press for Blackstone to do it now. You get more ink.
I don't know.
Because it's more outlandish after the rally to do it. Your point is these things need to be viewed through as a marketing / litigation management asset, not through predictions of the future. My thing is conflict of interest is frustrating.
The conflict of interest. I lost a lot of respect for Blackstone. Not that I had a lot to start with, but I lost whatever I had left.
BlackRock,
not Blackstone. BlackRock.
The interesting thing for you to say something like that, as an efficient market theorist, is that for sure the market is aware, even if the press is not aware. The market is aware of Blackstone's conflict to make a statement like that. And yet, it wasn't Blackstone alone that caused the market to continue to be such a little buoyant pool for the moment. You see what I'm saying? On the one hand, the market knows what you just said too, at least on the money side, if not on the media side.
Yeah, sure, of course, of course.
And it's a business, right? The media needs people to say outrageous things to sell papers.
Yeah, that's true.
So like they help each other. Like the Wall Street Journal needs the Larry Fink headline to get everybody worked up. Hopefully Sosnoff will be irritated beyond all belief. This guy, the hypocrite.
Yeah, I don't think they were too concerned about me, but
No, but there's a million of us. It's not you personally. They're like, all these people will be like these guys. But that still gets them talking. I mean, is there anything from the trading perspective? Because I know you're an AI skeptic. I mean, is there anything with this rally that makes you want to be would you dare to intervene in anything at this point, pricing wise?
Yeah, I'm short everything. I'm short AMD. I'm short Microsoft. I'm short NVIDIA. I mean, today's working out, but
yeah. Even the last, so yeah. And is that long standing?
Yeah, I mean, not long standing, but I'm doing it in a defined risk way. But it's out there. I'm there.
So, do you think that being someone with a personal position that's a bit skeptical of the price points might be particularly irritated if someone came out with a double upgrade, citing the chip space?
Well, you've got to be a player to start with. Otherwise, why would anybody care?
I understand, but it might be particularly agitated if someone come out with a double upgrade, not a single upgrade, but a double.
Yeah, but I play the game every day anyway, so I mean I'm just a rare one, in that sense. All right, we can move on. Next topic.
So I want to return to something we didn't have time for, and I think it was last week or the week before, which goes to the future of all money, which is even bigger than Larry Fink, which goes to the sort of the tasty trader at one end and the Oklahoma retiree at the other end. And if we were to bring money into the engaged space, how much of the available investable pool do you think could be more engaged with the right tools? Half of it? A quarter of it?
Which pool? How big is the pool?
All the investable money that's in passive index or brokerage.
I was, I think so. So I am I'm an advocate of obviously the transition from passive to active, and I feel like I have a set of numbers that I use, and I think the amount that could transition over is double what it is today. Double.
And what percentage of that is that of the total pie? Is that from 5 to 10, 1 to 2?
Yeah, it's from
3 to 6.
It's probably somewhere from 5 to 10 to 10 to 20.
Okay, so let's just call it 5 to 10 to be conservative.
Yeah.
And what's the barrier to that 5 to 10? Communication, I presume, in some fashion.
Well,
your assumption is that people understood how to.
Yeah,
do
but
this.
today the level of the types of communication and the level and the amount of information out there and the speed at which it travels, it can happen relatively fast. I was talking to someone yesterday from one of the exchanges, and we were having this conversation about just option volume, just to give you an indication of where my numbers are coming from. And like on an average day, there's I think it's around 45 or 47 million option contracts trade, something like that. 45, let's just say. And, years ago, it must have been like 8 or 9 million. Now it's 45 million.
Years ago, meaning 2009 or 99 or 79.
Yeah, something like, I think 2008 2008, 1999 was probably a couple of million contracts. 2008 was maybe 10, 12 million contracts, like something like that. And now we're at, 45, 47 million contracts. The most I think we've ever traded in a day option contracts. This is all the option exchanges listed in the US. I want to say it's like 70 or 72 million contracts. And I said to this person, I think one day in 2024, we are going to do 100 million option contracts in one day. 100 million. Double what the average is on a daily basis now. We're going to do 100 million option contracts. We're going to, so my number is based on that number. You know, the exchanges right now, I think the number I heard is they do about 50 billion,
And
50 billion quotes per day, messages per day, not quotes, messages. 50 billion messages at a single exchange right now. That number is going to go up to 100 billion. So I think that we're in a world right now where, you know, that transition is going to be about double. Yeah, probably double of whatever.
And do you think that represents sort of the sort of balanced state of the sort of total investable pool of 1 in 10, $1 in 10, even though that dollar might do 95% of the transactions, and the other $9 might only do 2 or 3 transactions relative to that $1 that's active?
That transition will come at the expense of, you know, a lot of passive money. So yeah, it will move the market, but in the opposite direction.
What do you mean in the opposite direction?
It's going to move out of passive longs into much more,
right.
You know,
But do you think that it can go to 20% of that money? Do you think it could go more than that, or do you think
I think it could go to 20%
over the decade, or it's unknowable because of the weirdness of time and information and randomness? It could happen in a weekend if you're not careful.
Everything happens so fast right now. It could happen in a weekend type thing.
I know, or maybe whatever. It's just a matter of when.
The state of today's technology, the speed at which we develop technology, the state of where we are, component wise, you know, like 25 years ago, 30 years ago, we would have to build technology that was fully integrated from front to back, so there were no independent components. So the platforms were always at risk for one piece going down, break everything. Today's technology is completely different, and everything kind of lives in its own world. And
you're saying because of role-based design in the network,
everything is so much better than it was before, and the speed at which we can do things and the cost of the technology. Yeah, I think you're going to see a very different world, and it's going to happen quickly.
%30?
It would be nice. I can see it happening. Like I said, I think the numbers will. I think the marketplace will support that. The numbers will support that. I really believe that we're onto something. I just don't know. You know.
So then how do you do, let's just talk, I mean, this will be a teaser. This is a cliffhanger for next week at this point. But so the banana, okay, yes to everything, right? Sure, everybody's in the pool. Sounds great. The banana peel in this, in terms of customer acquisition and customer experience for new users, so to speak, is 3 out of 4 or 2 out of 3, or you're going to tell me 1 out of 2, but I'm going to be somewhere between 1 out of 2 and 3 out of 4 positions are losers. And so the only way you can live in that ecosystem is to size yourself correctly enough, which is the skill that you teach, and Ilya and Chris, and you have a whole network of people. And then you're not the only one. There's other people that have versions of this discussion. But like that seems to be the friction point for customer acquisition, in my opinion. It's sort of like how to create the trading experience to tolerate that level of outcomes, and because of sizing, that allows you to survive it and to last longer. Because one of the most insightful things that I've heard you say in public when you do these various gatherings of yours is around time time at risk is one of the most critical and underestimated variables that's empowered by sizing correctly. So you increase your odds in terms of buying time, and that learning that behavior for me as a student, is, I think, the most essential variable in this entire undertaking between understanding it and applying it.
It's a good point. I like to think that because we're kind of dinosaurs, I like to think that over the years we have experienced that the transition that I think a lot of other people are going to experience en masse going forward. So, we've gone from being the pit trader to the large pit trader to the large retail customer to the small retail customer, all in an effort to figure this game out. And I think we have a pretty good handle on it now from a risk perspective and from a trading perspective. And I do think that the retail investor will be able to handle this with the technology. I'm just hoping that on an exchange level, on a regulatory level, everybody can play nice so that we can get there way faster. So we're not like waiting on one of the regulators or waiting on one of the exchanges or something like that.
We have the DeLorean problem where too many people want it and you can't make it.
Yeah, exactly.
And then the business fails the other way. Too much demand, no supply.
Yeah. Yep. It's really fascinating. I mean, the benefits are just off the charts, and I think that I think people are going to flock to it. It's going to be crazy. That does not mean the market goes higher.
No, it's interesting, but it does help, just to tie a ribbon on this discussion. The more active traders that exist at any size, the more active the shareholder is by definition. It's also, so the point that we're going back to the abused shareholder discussion at the top of this, or the sort of abuse of the shareholder structure, that the key narcotic for that abuse is passive. And so as you create a larger active pool, you'll also create over time a more engaged shareholder.
Yeah, the passive investor is the cancer to the whole system. That is the problem.
That's the narcotic.
It's long been my argument that, again, the Jack Bogles of the world, anybody
for the board of directors to do anything they want with management.
Exactly. And it goes much beyond Jack Bogle. I mean, it goes to the BlackRocks of the world and everything else.
Country club culture of the Northeast.
Yeah, that's why I want that stuff to stop. I want that stuff to be disrupted because I think all of it is bad for business.
To be continued. Watch out for God's banana peel. There's more losers than winners in that pot. Got to be careful.
I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Good discussion today, Dylan. Thank you.
Thank you, sir.